Hello, M&A scientists. Here at M&A Science, our goal is to continuously expand our understanding of M&A and use that knowledge to create top-notch training programs and resources. By visiting mascience.com, you'll find all the information you need to take your M&A skills to the next level. Get started by signing up for our free weekly newsletter. Stay up to date on our latest courses, upcoming events, and expert interviews. Again, that's mascience.com. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Scott Crofton, partner at Sullivan and Cromwell. Sullivan Cromwell is an American multinational law firm that handles high-profile work such as complex M&A, securities litigation, white-collar defense, and government investigations. Today, we're going to talk about the intricacies of mergers of equals. Scott, how you doing today?
I'm good, thanks. Thanks for having me on today, Kison.
Well, thanks for taking a break from the big deals to have this conversation.
My pleasure.
Can we kick things off with a bit about your background?
Sure. So I've been a practicing lawyer for 17 years. I went to law school at Columbia, and I had a vague idea of wanting to practice corporate law, but I didn't know exactly what that meant. And when I started my career, I was a generalist. And so I tried a lot of different things. I worked on securities filings. I worked on private fund formation and debt financing. And I found a number of the things that I tried tedious, but I immediately took to M&A. I loved the adrenaline that you feel on a deal. I loved the roller coaster nature of deals and the highs and lows. And I found that was what really got me excited about getting up and going into work in the morning. And so once I really got into M&A, I committed to it, and I've been doing it ever since.
And you work in the capacity to work on all different types of deals. Are you working across industries as well?
I am. So I spend a good amount of my time in the industrial space, but I've done a number of life sciences deals as well. We view ourselves at Sullivan and Cromwell as industry agnostic. We focus on getting the deals done. We have a lot of relationships in different industries, so we'll know key executives and board members in places and bankers, and that helps us develop relationships with folks. But at the end of the day, fundamentally, a deal is a deal, and we think we can work across industries. So I work on a lot of different things.
Have you ever found any specific industry have more maturity when it comes to M&A or creativity or something unique?
That's a good question. So I find that the life sciences industry is really driven by M&A. So a lot of the big pharma companies, they have reduced their overall R&D spend, and they've increased their M&A spend. And so you'll find that they have fully built out functions where they do a ton of M&A. They're kicking the tires on hundreds of deals a year, and they really know their business well. And they're looking for how do we, develop the pipeline. They're also in an industry. I'm going to start over. They're also in an industry in which there's always patent cliffs, and they run the risk that their products will have reduced revenues due to the fact that they. So I'm going to start over again. They run into the risk of having generic competitors come in and significantly reduce their revenues on any given product at any given time. So their products have limited life cycles. So they always need to be regenerating and developing new products that they can sell on patent exclusivity. So that gives them a ton of reps at just doing deals. And they're very thoughtful and constructive at the way they approach deals to try to develop their pipeline.
All right. Now I know where to go to take my next M&A notes here. The merger of equals. Now, Scott, I came up in the industry with the philosophy that there is no such thing as mergers. Everything is an acquisition. So can we break this down? What exactly is a merger of equals? When does it happen? What does it look like? Is it actually a thing?
Sure. And you are not alone in the view that there's no such thing as of a merger of equals. But the reality is that there are deals that bear the hallmark of a merger of equals. So when we talk about an acquisition, what we're really talking about is a deal in which there's a premium being paid to take over control of a company. The target company stockholders are receiving, a 30 to 50% premium on their stock. The controlling company gets to call the shots. The CEO of the buyer gets to run the combined company. The company is certainly not changing its name. Any changes to the board of directors would be modest at most if those take place. And the culture of the combined company is really going to inherit the culture of the acquirer. A merger of equals is designed to be different from all of that. It's designed to be a transaction in which no one is taking control. So there's no control premium paid to one side or the other. The deal is typically structured as a stock for stock deal, so it's tax free. So that gives it a nice little economic boost to the economics of the deal. And there are a lot of social issues, because if you're not having one company acquire the other, then there's no one party that gets to call the shots. And you need to resolve those social issues in an equitable way that's going to leave both sides comfortable with the idea of combining two companies that have, to at least some extent, a different culture. And so those social issues are can be thorny. They're topics like who's going to run the combined company. So who's the CEO? What's the succession plan at the CEO level? What does the board look like at the combined company? How do you comprise it? How do you take two boards and turn them into one? And how do you make that board a manageable size? How do you allocate subcommittee positions? Where's the company going to be headquartered? Where's the sort of the focus of power going to be at the company? What's the company's name going to be? There are a lot of different questions that come up, and a lot of times merger of equals die before they get too far because of intractable issues related to these soft social issues that come up.
So we have the characteristics of this mergers of equals is no control change. This is a tax-free transaction. I like the sound of that. And there's no premium being paid with that. So and we'll talk more about that. And then there's the social issues that you got to address, which is who's going to be the CEO? What's this combined board going to look like? How do we right size it as well? The subcommittees that may need to be created, and then where's the headquarters going to be? Well, I'm curious on some of these. When you talk through having a tax-free transaction, and then also there's no premium being paid, how do you address those things? I mean, is it just, yeah, how does that come to be? Because if a transactions happen, usually there's always tax things around it, and then there's got to be some assessment of value. And how do you define that and position it where there's no premium technically around it?
I'll take those questions in order. So first, on the tax side of things, there are ways to structure a deal so that if you're not receiving cash in exchange for your stock, but you're receiving a different form of stock, that the government doesn't view that as a taxable event. So therefore, as a stockholder, you maintain the basis you had in company A in the new company B or the combined company. So you never have a taxable event. It's basically like you just continue to hold your stock. So if you bought, Apple 30 years ago and you haven't sold it, you haven't had a taxable event occur yet. It's the same thing that the merger of equals doesn't trigger that. So there's no involuntary taxable event that takes place. So that's fairly easy to structure in an all stock deal. From the perspective of sorry, what was the second piece? I just want to make sure.
The second one was the premium part of it, because
Right.
you got to address some value on this organization or transaction happening.
From the perspective of the stock premium, or the lack of a stock premium, from the perspective of why there is no stock premium, the answer to that question is you ultimately need to come up with a third-party way of valuing that. So for two public companies, you're going to compare and contrast. Well, company A's stock is at 37 for a market cap of 5 billion today. Company B's stock is at 65 for a market cap of 4.8 billion today. There will always be a degree of argumentation as to, of course, we don't use the spot price. We use a VWAP of some sort. Is it 20 days? Is it 60 days? How do you measure it? But you're going to use the two market caps to compare. And you're going to come up with the method to come up to say, more or less, we should have an exchange rate that reflects basically just if you'd swapped one stock for the other. And so that usually leads to a very small premium, and it depends on what mechanism you use as to whether the premium is whether there is a premium or how it's calculated. So a lot of people do the same math and come up with a slightly different number, but there's no 30 to 50% premium that we see in a lot of M&A takeover type transactions.
What does VWAP stand for? You said VWAP? I thought it was an acronym used.
Yeah, the volume weighted average price. So a lot of the times you'll take, for example, the typical one is a 20-day volume weighted average price. And so that's, you look at the last 20 trading days and you take that volume weighted average price and you say, okay, it was 36.27 here, it was 42.25 here, and you average it all together and you come up with a number. So the bankers will spend days and days arguing about which is the right metric to use here. And coincidentally, their math always aligns with what's in their client's interest. But usually you wind up with a solution to that if you figured out the thornier social issues.
How's this work in a private deal?
Well, that's trickier. There's no question. I've done one of those, but that was there was a company called Inventive, which was private equity backed, and it conducted a merger of equals with another company called INC, which was public. And the answer is, it's really the same way you conduct any other private deal. You eventually need to find valuation, even of a private company. And so you're going to use the typical tools that bankers use. So there will be some sort of discounted cash flow analysis where they'll look at future earnings and they'll discount those to try to come up with the math that would work. There's a sum of the parts analysis where you try to evaluate individual pieces of the business and decide what it's worth altogether. You look at comparable transactions for companies with similar EBITDAs and other financial metrics, and you try to compare those. And you're comparing company A with company B, right? If company A has 6 billion in revenues and $1 billion in profits, and company B is very close to that, I think you probably recognize that the valuation here is overall pretty close. It may not be quite as scientific as using a volume weighted average price, but the same idea still applies.
What do you usually see more? Does it happen more in the public setting or private setting?
It is certainly more common in the public setting, I would say. And it's a transaction that only works in certain circumstances because of all the soft social issues that I described. So it works best in a situation where there are two CEOs who have complementary visions of the world, and where one CEO is prepared to no longer be the CEO of a combined company. Maybe they want to step up to a more senior role to be the chairman of the board, and they're ready to retire from full-time duties. Or maybe there's going to be a transitional plan in place where one person is going to be the CEO for a few more years, help groom his successor, who would be the other CEO, who would then ultimately step into the role of CEO. But you need to really have the right mix of CEOs sort of at the right point in their career cycle, and the two companies that are in the right place where it makes sense. There's a ton of synergy there. Their cultures aren't so dissimilar, where they can try to find a way to make things fit together. So it's a tricky dynamic, but I think it's most common in the public space where you have those factors in place.
That's what I'm still trying to wrap my head around is how do you get these two management teams to come together? If you got CEO doesn't want to step down, how's that going to work?
Well, the short answer is that usually doesn't work. And look, I don't want to sugarcoat it. There are examples of some of the world's biggest mergers have been failure. Mergers of equals have been failure. So AOL Time Warner was a merger of equals. I think that's generally recognized to be one of the worst deals in corporate history. So there are situations where it doesn't work, and a merger of equals I would view as the exception in the M&A world, not the rule. Acquisitions are more common, but there are situations where there are two similarly sized competitors who have complementary businesses, and 1 + 1 doesn't equal 2, it equals 3. It's just a question of finding the right situations and putting in place the right conditions and rules around how the combined company is going to be run that actually work, so that the combined company is a cohesive whole once it's combined.
Do you have an example of it working really well?
Sure. I think there are a variety of examples. My client L3 Harris is the product of a merger of equals, and I think they've been quite successful since that took place. I think part of it is the question of, are you going to go with sort of an us versus them approach versus a we're all on the same team approach? And it's easy to describe that on a podcast, but putting that in place effectively in the real world can be challenging, but you can create a ton of value when you do it.
It's ironic you mentioned that. We've had Daniel Gitzevich, who heads their corporate development, on the podcast, and we've briefly mentioned it, but maybe that's one to revisit and take apart further and how that's been working. Going back to this management team, so taking that deal as an example, what about the rest of the management team? Obviously, there's the CEO and figuring out who's going to lead and if one is ready to move in a different direction, so that they can work well together. But the different functional leads, the rest of the C-suite, is that similar? Like, how do you figure out how that's going to come together?
I think those decisions, different deals make those decisions on different timelines. And so in some deals, you'll pre-bake everything up front where you have the decision, okay, this person's going to serve in the CF role, this person's going to serve in the GC role, those types of decisions. In other deals, these conversations take place at such a high level. It's the chairman of the board talking to the chairman of the board. And it's really a board-driven process, unlike most deals, which are more management-driven, that sometimes you don't get into all of that at the earlier stages. Now, the two CEOs may have ideas how that works. And frankly, when the two CEOs have those conversations, there may be some sort of informal understanding. But typically, it's only the CEO role that's going to be formally documented and reflected in the public announcement of the transaction. On some deals, they take what they call a best of breed approach, meaning that they'll functionally have folks interview for their same roles at the combined company, where they'd be taking charge. One person will take charge of a twice as large company. The other person may find a different role within the organization, or may move on to different things. But it's a concept that creates a lot of stress within an organization leading up to a merger of equals. And that's why these conversations take place at a high level. And oftentimes they don't move forward at all. But when they do, this is what happens.
Yeah, I can imagine, because an acquisition happens, you sort of see it coming that, hey, they're acquiring us. I got some uncertainty about my role in the coming future here. You can see that. But this merger of equals, who's the best fit? Are we going to have a bake off to see who's going to run this division going forward, combined? So I could see that. How about the board of directors? Because you mentioned you can't just add them all up and have 25 board members. How do they right size that? And is that like a similar exercise?
So the board composition is typically, you're typically not going to wind up with a much larger board than one or the other board. There are some key questions around, well, who gets more directors versus the other side, right? And so there are different ways to handle that. One is to take the approach of, we're going to legislate for exactly how this works. One side has 6, the other side has 6. We'll have an even number of directors, and one side's company will take the chair role of these two committees. The other will take the chair role at the other two committees. And you can prescribe things that way, and then put in place super majority rules so that those rules can't be upset for a period of time. In other circumstances, you take the approach of, we're all in this together, and we're going to form a board with overall the same number or very close to the same number of directors. We're going to hardwire the CEO rules, but otherwise we're going to have a lot of retreats and try to find our kumbaya moment so that we view ourselves as a combined company. So it really depends. We see both in nearly equal amounts, and it just depends on the approach that folks want to take.
You're not making any of this sound fun or easy at all.
It's not. Well, it is fun, but it certainly isn't easy.
Fun for who? For you?
For the transition folks, it is. And look,
yeah, they got a lot of work to do.
It's the opportunity to create a company that you could never create in any other circumstance, right? Because you're functionally two companies that could never buy each other have a way to come together and create a much larger competitor. So a lot of the biggest companies in the world today, frankly, have been created by mergers of equals in the past. So the reality is that, while it's not always fun for everyone involved in the transaction, it's a transformative deal, and it allows you to do a deal using no cash that creates a company that's twice as large, which is functionally undoable in any other way.
Good point. Can we talk about the execution of these type of mergers? Maybe we can walk through a timeline of events that happen.
Yeah, sure. So like I said, the conversations that take place are typically at the board level rather than the executive level as an initial matter. Because of the disruption that a merger of equals can create, as you rightly noted, you're not going to have a big tent of folks involved in the deal until it's very clear that this has legs. So you'll have a very limited number of advisors involved. You'll have the boards of directors of the two companies involved, and they'll probably be talking to their CEOs. And those CEOs may involve a couple of their direct reports, but not more than that. And that's the dynamic in which the key social issues that I'm describing get hammered out. And the majority of the time, those key social issues don't get hammered out. It's only once you find an agreement on those threshold type issues that you're going to advance the ball, and then you're going to advance the ball very quickly. To be candid, negotiation of the deal itself is typically rather easy because the parties know each other's business very well. They're very familiar with it. They're in the same industry, so they know what to look for. You're going to keep the deal is so big and much bigger than any other deal you do that the materiality thresholds that you're going to think about, well, here's a red flag, are going to be much higher than they would be in any other circumstance. So the diligence you do is very targeted and focused on what are the big picture issues. And then when you're involving the other key components of the deal team, an outsized portion of it is around communications, because explaining to the markets why combining these two companies is a very delicate topic. The market knows there have been big merger of equals that have failed in the past. They're going to want a good story as to why this makes sense. And both parties are putting themselves in play, because they're both announcing functionally that they are, while not control isn't up for sale, that functionally they are up for sale, and they're conducting a transformative transaction. And you don't want to go out announcing a transformative transaction unless you have a very good story as to why this is the best decision and will create the most value for stockholders. And then I guess lastly, there are key components related to communicating with customers and suppliers who may use both parties or may have a view about one versus the other. So you need to come up with a very carefully crafted message to them as well. And so the step from agreeing on the key social issues to announcing the deal is usually very short. It's a matter of a couple of weeks. And so things move very quickly on a merger of equals.
You still need to send out an LOI.
You do. Well, the LOI, frankly, it's usually a dinner conversation between the chairman or the two directors who talk about the transaction. And then you'll have the LOI that spells out the social issues. So let's say we spend 4 weeks talking about the LOI, but it's really going to cover those key social issues. The bankers at the same time are talking about their view apps and the math that makes sense to make the deal work. And then when those key issues are hammered out, call it after 4 weeks, then 2 weeks later, you're announcing the deal because you have a merger agreement signed.
But there is like an official LOI?
Not always, but usually there'll be some sort of term sheet that says, okay, the headquarters will be in place X or place Y. The name of the company will be Company A. Company B will hire a consulting company to name it Company C, or we'll say it's Company AB now, right? Combining the two companies' names. So it's usually one of those. So that's the term sheet that usually created. That's when you're talking about the social issues.
And that sounds like it's very mutual.
It is. This is all very mutual. It's easy to negotiate the contract because what you're giving is what you're getting, because you're basically both the buyer and the seller in the deal.
And what does diligence look like? Because again, you do an acquisition, it's very buyer-driven diligence process. Who's driving diligence here?
It's very easy to rein a client's diligence requests in a merger of equals, because I've told clients this before. Whatever you ask them for, they are going to ask you for the same exact thing. And that really disciplines the client's mind around, all right, let's ask for the stuff that really matters and that is relatively easy for them to produce. So I actually find that it's a very orderly diligence process for what it's worth.
I'm having a hard time imagine that. Let me see your customer list. Well, let me see your customer list.
Exactly.
Let me see your employment agreements.
Exactly.
It doesn't spin out into any passive aggressive diligence behaviors around there, does it?
I mean, look, there's always passive aggressive diligence behaviors, but no, to me, at least in my experience, the diligence process is the least of my concerns on a merger of equals.
Okay. Yeah, just it might not have large organizations, and you just know teams have their own concerns, and may not be completely on board with the decision there.
Well, that's certainly true, right? You always need to manage for the fact that individuals in an organization may not be happy about the idea of a merger of equals, and so um, a deal team and the manager of an M&A process needs to be disciplined about who they're bringing into the deal, and to make sure that they're getting the right advice as to how, what are the issues that matter and what are the issues that don't matter.
That's why communications is so important.
That's right. That's right.
Having a good strategy, painting that narrative and picture. Given that, because I take it there's usually an announce period and then you sign and close. Um, what impact do you typically see this making, or does it just completely vary when you announce the merger of equals?
Well, your goal is to have a stock pop, right? And there are reasons why there should be an increase in both parties' stock price. The two stocks will trade in tandem because they're eventually going to be exchanged for each other, assuming the deal is going to go through. But the expectation is that there are going to be synergies created by the transaction, both on the cost side and on the revenue side, because they're complementary businesses, and you can streamline some things and you can cross sell other things. And so, 1+1 = 3 is the theory behind it, right? So you're expecting that stock pop, and you're expecting for the market to like the deal. And I think that more often than not, the market does like the deal. The risk you're taking, though, when you're announcing a deal for yourself, is that you've put yourself in play, right? In a typical situation where you haven't announced a merger of equals, if someone were to come in and say they want to buy your company, you have a variety of answers, including we're not for sale. We have a long-term plan. It doesn't involve this. We think we can create more value for our stockholders by remaining independent rather than selling to you, interloper, who's coming about at an opportunistic time. When you've announced a merger of equals and before you've gotten stockholder approval for that merger of equals, your board has the right to change its recommendation for the deal, which can fundamentally crater a deal. And so if an interloper comes in that time period and is offering a significant cash premium, you have really let down your defenses from that interloper. And so it's a situation which, for that 3 to 4 month period before you get that stockholder approval, if someone comes in and proposes a premium cash bid, your story as to why a stock for stock deal in which your stockholders aren't having a taxable event, but they're also not getting, a 40% premium, have to be convinced by the merits of your argument. And typically, while there is a positive increase in stock price when a merger of equals is announced, it's usually not 40%. And so that's why your goal from announcement onwards is to convince the markets of the logic of the transaction that you've done, to insulate yourselves from the idea of someone coming in and trying to offer a cash premium that you, the board, and you, the management team, may believe that as of right now, this, the cash is higher, but we're actually creating long-term value by combining these two companies. We've created something that couldn't be possible just on a standalone basis.
That happens though. The company will come out of the woodworks and say, "Hey, we're interested now."
It does. It does.
And you got to go through a process. You have to have a formal review. And what does that look like?
That's right. That's right. So our firm represented a company called Merck when it came in, and it bought a company called Versum, which had announced a merger of equals with another company called Integris. And so they came in with a price that was a premium to the deal price, and that was a premium to where the stock was trading. The counterparty needed to the target company, which was in the merger of equals, need to assess it. So they would then call their financial advisors in, and I don't have visibility as to what was going on their side of the table, but they would talk to their financial advisors, get advice as to the fairness of the consideration that was being offered in the stock deal, and look at all the pieces that went into the fairness analysis that underlaid the fairness opinion that board had received, and compare notes against what they were receiving as an all cash deal. And then they need to assess which deal is more beneficial to their stockholders from a financial point of view, if they were to complete it. And there's oftentimes when that takes place, the answer isn't initially a yes right away, we're going to take this transaction. There can be a back and forth. The merger agreement likely includes a series of what we call deal protections. And so what that means is that when a party to a merger of equals receives an unsolicited inbound proposal, they have the ability to consider it, but if they were to decide that you know what, this acquisition deal is superior to our merger equals deal, then in those circumstances, they would first have to go to their merger equals counterparty and say, hey, this deal is superior to the merger equals that we're talking about. I'm sorry, we can't move forward with it. And the merger equals partner then has a chance to match and say, I actually will sweeten the deal for you by doing X or Y in order so you don't terminate the transaction. And then the subject company that's the subject of the interloper bid and is part of the MOE, they need to decide which deal is better for their stockholders. And if they ultimately decide that the acquisition proposal is superior for their stockholders, then they're going to need to pay a termination fee of, call it 3% of the deal value that or of the company's value. So it's a significant number. But they ultimately get comfortable with paying that premium because it's functionally the buyer or the interloper in this circumstance who's paying that premium because they're buying the company. And so when they acquire the company, they're functionally taking over that premium for themselves.
It's a lot more complicated. Hey, so this is your Black Knight when you get the.
That's exactly right.
Finally, I get to use that term on this podcast.
Glad I could help you.
Well, then we can talk about a poison pill.
Sure. So a poison pill is a deal protection device that a company can adopt. It functionally creates preclusive dilution for anyone who goes over an ownership threshold. So if you set a poison pill at 15% of the company's outstanding stock, if someone were to buy over that, they would functionally be diluted in half. It would be a disastrous scenario for them. No one has ever intentionally triggered a poison pill. And so it's a very powerful weapon to prevent someone from taking over a company. And so if the poison pill is put in place, anyone who's interested in acquiring that company is not going to burn through the poison pill. They're going to try to replace the board and remove the pill before they do it. So a poison pill is a very drastic weapon to use, but it ultimately can be overcome by taking over the board.
Is that usually in there as something by default, or when a Black Knight shows up, the board creates the poison pill?
So if you have a signed deal, you don't typically create a poison pill. A poison pill is more often used when an interloper shows up without another deal that is in competition with it. It can, in theory, be used for that. But if a Black Knight shows up and the board recommends against the Black Knight's deal and still in favor of the original deal they have, the real vote, the stockholders are going to have their day, and that day is going to come at the stockholder meeting, where they're going to either vote up or vote down the original deal. Once the original deal has been voted down, functionally that's the end of the day for the original deal. Now, the board can delay that meeting and can try to put it off so that they can try to get more stockholders to vote in favor of it and go work the phones more to talk to the BlackRocks and the smaller investors of the world about why the deal makes sense. But if a deal ultimately gets voted down, the deal's never going to go through.
I'm still lost on the poison pill part of it, because is that something that's already sort of there to execute on, or do they actually act on it or create it and say, hey, we're going to add this to, I don't know what the document they would add it to, but.
Oh, sure. Sorry. So a poison pill is typically, the typical American company today does not have a poison pill in place. A poison pill is something that companies adopt when a hostile acquirer comes in and they're worried about someone buying up shares over a threshold. So if they're worried that, activist X comes in and is going to buy up control of the company to either vote down an existing M&A transaction or to basically try to acquire what's referred to as creeping control, meaning they're never going to offer a merger where all stockholders get the cash premium that they should receive in a change of control, but they're going to try to buy up shares in the marketplace. So they go, they take a 45% stake and that functionally gives them control of the company. Then the board of directors has not just the ability, but a duty to prevent that interloper to block that interloper from taking control of the company without paying everyone a premium. So it is a tool that is not in place at the typical company, but it is something that often companies have what we call on the shelf, meaning that they have the ability to adopt it at any point in time. A board of directors, what it is functionally it's actually issuing very small fractions of shares of preferred stock that attach to every share of common stock, which is the stock that you trade on the public markets. And those tiny fractions of preferred stock, they have these special rights that only go into effect once someone goes over the ownership threshold that is reflected in the rights plan that accompanies those tiny fractions of shares of preferred stock that attach to the common stock. And those rights functionally create value for everyone else except for the person who went over the ownership threshold. So it's a very sharp elbowed device that is not designed to actually be used, but it's designed to prevent someone from taking control without negotiating with the board.
Now I understand. So we got Black Knight, unsolicited, unwelcome takeover bid, and then we got our poison pill of essentially a tool to use that would dilute the acquirer from doing like a creepy takeover, sneaky takeover.
Creeping, yeah. Also maybe creepy, depending on your point of view. But yeah.
Creeping takeover. What about the fairness analysis? Can we talk a little bit about that?
Yeah, of course. So this is something that's also rooted in corporate law, and that's that a board of directors, they have fiduciary duties. They have a duty of care and a duty of loyalty. And so when they're considering an acquisition of their entire company, the duty of loyalty is one that's pretty easy to discharge, right? That just means that you're being loyal to your company. So in unconflicted transactions, that's very easy to deal with. The duty of care is a question of, have you functionally as a board member done your due diligence? And part of that is relying on advisors and your management team to give you advice. But there was an old case back in the 1980s where functionally the board was found to not have discharged its duty of care because they had not educated themselves about the value of their own company before selling it. And ever since that case came out, it has been market standard for any public company that's board agrees to sell themselves to get the advice of a financial advisor and to have that advice documented in a fairness opinion. And that fairness opinion tells the board that we are your professional advisors. We've conducted analyses, and they've also presented those analyses to the board. And in our educated opinion, this transaction is fair to the stockholders of your company. And because the directors can rely on the opinion of experts, that inoculates them from a claim that they have not complied with their duty of care. Now, that's the technical legal reason why people do it. As a board, you also, frankly, want these sorts of analyses, right? You want to have folks who live and breathe the industry and understand how it all works, conduct the financial analyses, the discounted cash flows, the comparable transactions, the comparable companies analyses to confirm that, yes, the value that your stockholders are going to receive is fair to you, right? It's kind of intuitive common sense, but it's also something that gives them a legal shield. And so those analyses are a big part of what financial advisors do on a transaction. They give that comfort to the board of directors. They also do a lot of other things, but that's the sort of technical, formal portion of their role.
And fundamentally, this would be similar in a private company deal as well.
It would. A fairness opinion is something that's helpful in a private company deal. If, for example, if you were to sell your company, it would be up to you ultimately as to whether you got a fairness opinion or not. You're probably going to want to get advice one way or the other as to, is this a good price for my company? And so it's not universal that in private company deals there's a fairness opinion given, because the stockholder isn't going to sue himself as the board of directors for a violation of it. But the same principle applies that you want to get a market check, and functionally the fairness opinion is a formalistic version of the market check or the market advice that you're getting.
Who gets sued on these deals, especially the public ones? Because I feel like every time there's a big transaction, somebody's not happy and then they sue somebody.
That's true. Well, a lot of there frankly is a robust plaintiffs bar in our country of law firms that will represent stockholders who may hold very marginal amounts of shares, and they will assert disclosure violations, or they'll assert fiduciary duty claims. Both of those claims will go against the company, against its directors, and sometimes against its management. We frequently tell our clients that if you're doing a public company deal, you should expect to be sued. And we are going to guide you through, and the process you're going to follow is going to inoculate both the company and you from any liability from those claims. But you should prepare yourselves for the fact that will happen. Now, a lot of these claims are frankly not particularly robust claims. They read through the proxy statement, if they read through it, and they tried to claim that just not enough information was given. But at the end of the day, they're often looking for what we would view as immaterial information, and that can also be resolved through additional disclosure. And then when you'll make that additional disclosure, oftentimes those lawsuits functionally go away, or there's some sort of nominal settlement, or what we call a mootness fee that is paid to resolve those. So the vast majority of deals get sued. The vast majority of these lawsuits get settled for nominal amounts.
That's a whole other little ecosystem that
It is.
probably exists in America and maybe one other country. I don't know.
My overseas clients are always entertained by the existence of this world. So sometimes you need to hold their hand through it a little, but they eventually get comfortable with it. I think we're the only ones, though.
Yeah. I wonder if there's like a data analysis on just lawsuits per capita across, compared country by country.
That's true. Well, Brazil has a lot of lawsuits, but I don't think the same stockholder suits we do.
Yep. We got it both on the individual and corporate level. So I think we rank pretty high on both sides. Can we, on kind of wrapping things up here, run through the pros and cons of our mergers of equals here? What are the advantages of mergers of equals?
Sure. It makes deals happen that could never otherwise happen, because you don't need, frankly, they don't involve debt financing, so you don't need to go out to the debt capital markets. You are able to combine. Neither of these companies likely has the cash to do this type of transaction, so it unlocks an entire new level of transaction, and it can create and it allows for very highly complementary businesses to combine. I think those are huge advantages, and that's where you can really create value. It also can create a natural succession plan in situations where if you have one company with a CEO who's ready to move on, there's no succession plan in place, but there's a very logical competitor or complementary business that has someone who's looking to expand their business. It really gives themselves the ability to create sort of the legacy building type transaction that a lot of senior executives and boards are looking to create. So there can be huge value that's created in those types of transactions. So I think those are the biggest pluses of a merger of equals. The challenges associated with these transactions, first, is the cultural fit, right? Can the two companies fit together? Do they have such a common culture that they're going to sort of fit together from day one? How do you create a combined common culture that makes sense for everybody and that keeps everybody happy? That can be tricky. There's the interloper risk that we've been talking about, right? There's always the risk that either company can be exposed to having someone come in and take them over instead. So while we thought the idea of combining A plus B made sense, that the intention wasn't to have a private equity company A or strategic B come in and buy the company and really actually take control of it. And we actually had a very thoughtful plan as to here's how we're going to manage the combined company, and here are all the opportunities we're going to have. Those all go away, and your stockholders are then cashed out so that they don't have a further say over the company, and they don't realize the benefits of the combined companies, or of the combined company or the individual company's upside on a go-forward basis.
And where does the time frame compare between doing a typical M&A deal versus mergers of equals end-to-end time frame?
A lot of times these things will be driven by regulatory, just given the sheer size of a merger of equals. Oftentimes there's a lot of regulatory filings that can be triggered. So in most of the MOEs I've done, regulatory will drive, but that doesn't make it different than other M&A deals. It's just because it's a larger deal, there are more filings that are triggered. It may also be that because there's an industrial logic to the transaction, that makes the regulators take an interest in it. So of course you need to have a good story as to why this is a pro-competitive transaction and it's good for the consumers. But oftentimes that actually is the case. But if there wasn't, assuming there is no regulatory hair on a transaction, then you're really talking, it's a, call it a 4-month time frame. It's not really much longer than an acquisition, a public company acquisition, because neither of those deals, you're going to have a series of SEC filings to get the stockholder meeting to take place.
What's your best advice for companies attempting to pull off a mergers of equals?
Good question. To me, it's make sure there's a good cultural fit, and that there's a story that makes sense as to why your key stakeholders, your key employees, and also your customers and suppliers are going to like this transaction. It's going to be a net positive. You don't want to go announce some big transaction and have it be value destructive and demoralizing to your organization. So it is not, a merger equals is not a deal for everyone, as I think you picked up on this. It really is a bespoke transaction that makes tremendous economic sense and makes tremendous strategic sense, but only in a very small number of situations. Bigger doesn't necessarily equal better. There needs to be a good story as to why these two organizations fit together. It's going to make customers happy. It's going to make suppliers happy. It's going to create additional value for stockholders. If all those components don't fit together, then it can create challenges and can be value destructive.
Culture and strategy.
Yep.
I don't talk about culture much. I'm thinking when I get some time, I should make an AI bot to figure out how cultures match between companies. I don't know. It's always the one that gets left out, then it either makes or breaks the deal. Scott, what's the craziest thing you've seen in M&A?
It's funny. So of the stories I can tell, I guess here's a story that, sorry.
Yeah, sorry, go ahead. No, I was gonna say, yeah, just no names and dates. That's all. We won't incriminate anybody.
Okay. I remember I guess a funny story was when I was a senior associate, I remember working extraordinarily hard on a deal. And when you're working on public M&A deals, the reality is that most deals get signed over the weekend, or at least a disproportionate number, because you have sort of the few extra days to have the race to a signing. And so you hope when you're one of the sort of the deal lawyers in the trenches that, all right, let's get this done Friday night. We're done. People can work on comms over the weekend and you can announce it. But the reality is that a lot of times deals use all the time up, right? So you're oftentimes signing and announcing a deal on Sunday night. And so I was on one of these deals. It was a public company auction. It was a hot auction, and our client had won the auction. We were very excited, and but it was clear that we were going to go down to the wire. And so we were working until Sunday night to get this deal announced. And it was in early February, and I was in my office, and it was actually Super Bowl Sunday. And so this was the first time that I'd ever worked and that I hadn't been able to watch the Super Bowl. And in the second quarter of the Super Bowl, I remember we all got an email from the data room provider saying that we had just been kicked out of the data room. And we just sort of all start calling each other, making sure. We thought it was just a glitch or something. And then our CEO calls the other side CEO, and it turns out that the answer is a topping bid just came in, but they demanded immediate exclusivity. And so I'm sorry, but this deal has fallen apart. We're not moving forward with you. And so we're just sitting here like, geared up, have our office dinners ready to go and are ready to work through the night. And all of a sudden there's nothing to do. And so it was a kind of a deflating moment for a few minutes. We're just sitting there just in shock and, talking to the client who's sitting in the middle of America, and everyone's just can't believe it. And then eventually we realized that the Super Bowl is still going on. So the deal team gets together and we head down to we're in downtown Manhattan. We head down to Stone Street, which is where there are a bunch of bars. And so we wound up getting to watch the Super Bowl halftime show together. And so it was a real bummer. When you get a deal that far, you're not happy to have a deal fall apart at the last minute like that. But at least we got to watch the second half of the Super Bowl, I guess.
The Super Bowl bomb at the 12th hour, but you had some beers and a game to watch to soothe it over.
Yep. That's right. So you got to take the silver linings out of everything, I think.
Scott, this has been great. Thank you so much for taking the time. I learned a lot from this conversation. I won't contest my billable hours when I get the opportunity to work with you.
All right. I'm looking forward to it. We'll take it easy on you, I promise.
Hey, thanks again, Scott. For those of you still with us, thank you for keeping through. And till next time, here's to the deal.